Hey friends, the DeFi Doctor here. I'm the head of education at Decentralized Masters, the home to expert crypto education. Now in this video, we're diving into a game-changing trend that could reshape finance as we know it. I'm talking about the tokenization of real-world assets, like gold, real estate, stocks, and bonds. This isn't a distant future fantasy. It's already happening, and the implications are massive. By the end of this video, you'll understand how tokenization works, the pros and the cons, and where this trend is heading. Plus, I'll share what smart investors are doing right now to position themselves ahead of the curve. All right, so on that note, let's get into it. Tokenization is the process of turning ownership rights of real-world assets into digital tokens on a blockchain. Sounds simple, but the impact is profound. Think about gold. Traditionally, if you wanted to invest in physical gold, you needed to either buy and store the metal or rely on centralized ETFs. But tokenized gold? That means owning fractional pieces of physical gold that are verifiable, tradable 24/7, and accessible to anyone with an internet connection. The same applies for real estate. Historically, it's been a high barrier investment class. You need a lot of capital, lawyers, brokers, and time. But with tokenized real estate, someone could buy a fraction of a rental property in Dubai or a commercial building in New York. They could receive rental income directly to their wallet, track appreciation, and even trade their stake on a secondary market. That level of liquidity has never been possible with real estate until now. And it doesn't stop there. Stocks and bonds are also being tokenized. Entire portfolios can now be mirrored on-chain. For example, platforms like Backed Finance and Franklin Templeton have already begun issuing tokenized versions of government bonds and equity indexes. This opens the door to 24/7 markets, automated settlements, and a future where asset management is faster, cheaper, and more transparent. Now let's talk about the upside. The benefits of tokenization are huge. First, you get accessibility. Investors from across the world, even those without access to traditional brokerage accounts, can own fractions of high-value assets. It levels the playing field. Second, liquidity increases. You're no longer locked into long-term commitments. You can trade fractional ownership of a building, a gold bar, or a bond with the click of a button. Third, transparency is built into the system. Blockchains allow for verifiable ownership, auditability, and real-time tracking of asset performance. There's also a massive advantage in terms of operational efficiency. Middlemen like brokers, custodians, and clearinghouses can be removed or reduced. Settlement times shrink from days to seconds. This cuts costs, reduces fraud, and creates a smooth experience for both institutional and retail investors. As someone who's worked closely with DeFi products and seen how on-chain infrastructure operates, I can tell you that this shift is not just theoretical. It's already proving more agile and secure than many traditional systems. But let's not gloss over the downsides. Tokenization brings complexity. You still need legal frameworks that link the digital token to the actual asset. If you own a token representing part of a house, what legal recourse do you have if the underlying property is sold or mismanaged? These are challenges regulators are still trying to figure out. There's also smart contract risks. If the code behind the token has bugs or vulnerabilities, you could lose access to your asset. Another issue is adoption. Most institutional players are still experimenting. Full-scale tokenization of global assets requires massive trust in blockchain infrastructure, and that takes time. And while liquidity is a strength, it can also be a weakness. Rapid price swings in tokenized markets could mirror the volatility we've seen in DeFi, especially if there's not enough volume or if regulations crack down suddenly. Still, even with these limitations, the momentum is undeniable. BlackRock, the world's largest asset manager, is investing in tokenization. JP Morgan has launched tokenized bond trades on its private blockchain. We're seeing real-world assets brought on-chain at a pace that would have been unthinkable just 5 years ago. I've personally seen how some of our advanced students at Decentralized Masters are already exploring these types of markets. They're using tokenized T-bills to park stablecoin profits and rotating into tokenized commodities to hedge against inflation risks. That's not just strategy, that's innovation in real time. Let's now look into the future. The full-scale tokenization of everything will likely reshape how capital moves around the world. Imagine a global marketplace where real estate in Asia, bonds in Europe, and gold in the US are all available to anyone with a phone and a wallet. No gatekeepers, no unnecessary fees. Just direct ownership and global liquidity. That kind of system could supercharge financial inclusion. It could allow a farmer in Kenya to invest in US equities, or a college student in Argentina to earn yield from a tokenized apartment in Singapore. This is where DeFi and TradFi begin to merge. As tokenized assets grow, DeFi protocols could serve as the new infrastructure for lending, borrowing, and collateralizing these types of tokens. That means the lines between traditional and decentralized finance are beginning to blur, creating a whole new hybrid system. From my perspective, that's one of the most exciting frontiers in all of crypto. We're not just building faster payment rails, we're rebuilding the entire foundation of capital markets. Of course, the pace of adoption will depend heavily on regulation, security, and infrastructure upgrades. We need strong legal bridges between tokens and the underlying assets. We need safe custody solutions and secure contracts. But these challenges are solvable, and the incentives are strong enough to bring real progress. Institutions want cheaper, faster, and more flexible systems. Tokenization provides all three. So what should you do as an investor? Stay informed. Start watching which assets are being tokenized. Explore platforms like Ondo, MatrixDoc, and Maple. Understand how stablecoins are already acting like tokenized dollars, and how that logic is now spreading to every other asset class. We're still early, but if you position yourself correctly, tokenization could be one of the biggest wealth building trends of this decade. All right, my friends, let's wrap it up. Tokenization is not hype. It's the beginning of a massive shift in how we think about ownership, liquidity, and access. Whether it's gold, real estate, stocks, or bonds, the move to bring these assets on-chain has already started. There are challenges, yes, but the potential value, both financial and societal, is enormous. So, thanks for tuning in. If you found this breakdown helpful, subscribe and hit that like button. Stay sharp, my friends, stay decentralized, and I'll see you in the next one.